Across the Russell 3000, board diversity in 2025 shows signs of real improvement, but the headline numbers often obscure persistent gaps. According to the latest Equilar Gender Diversity Index, women now hold just over 30% of board seats, a significant increase from previous years. More boards are reaching gender parity, with 185 now split evenly between men and women, and the pipeline of new female directors is growing. In Q1 2025, women accounted for 30.6% of new board appointments, a slight uptick that signals steady progress despite recent political pushback against diversity, equity, and inclusion initiatives. Yet, the distribution of leadership roles tells a different story. Women remain underrepresented in positions of real authority. Only 8% of board chairs in the Russell 3000 are women, and the numbers are only slightly better in the S&P 500. Even as women make up about a third of all directors, they hold just 11% of chair positions and 17% of lead director roles. The pattern is clear. Boards are diversifying at the margins, but the top jobs still go overwhelmingly to men. Meanwhile, a stubborn 2% of Russell 3000 boards remain all-male, a figure that has barely shifted in 3 years. While this is a dramatic improvement from the 22.5% seen in 2017, the remaining holdouts highlight the limits of voluntary change. Racial and ethnic diversity has not kept pace with gender. After an initial surge in non-white director appointments following 2020, progress has slowed. The share of new non-white directors fell from 48% in 2022 to 31% by 2024, and black director appointments dropped by more than half in that period. As of 2025, non-white directors hold about 26% of S&P 500 board seats and 23% in the Russell 3000. The drop coincides with increased scrutiny of diversity policies, including the reversal of Nasdaq's board diversity disclosure rules and shifting legal standards that have made some companies more cautious in their approach. Industry differences are stark. Technology companies have made the most visible gains in gender diversity, with firms like Apple and Microsoft reaching gender-balanced boards. However, these same companies lag in racial inclusion, with Black and Latino directors still underrepresented. In banking, some firms have moved faster on racial diversity than gender, while energy and industrial sectors continue to appoint mostly white men. In 2024, 78% of new directors in these industries were white men, and some major companies only recently added their first Black or female directors. The data supports the business case for board diversity. Companies with diverse boards report stronger performance metrics, including higher EBIT margins and fewer regulatory violations. For example, pharmaceutical firms with gender-balanced boards saw 37% fewer FDA violations last year, and boards with a mix of backgrounds handled crises more effectively, opting for pragmatic solutions over prolonged legal battles. Still, the relationship between diversity and performance is complex, and it's difficult to separate cause from effect. Well-run companies may be more likely to invest in diverse boards, but the presence of different perspectives appears to improve risk oversight and decision-making. Despite the progress, tokenism remains a concern. Many boards adopt a two-and-done approach, appointing 2 diverse directors and then pausing further efforts. At 28% of S&P 500 companies, this has led to surface-level diversity without real inclusion. Diverse directors often wait longer for meaningful committee assignments and can feel excluded from important decision-making. On average, these directors spend 22 months before joining key committees, compared to immediate appointments for their white male peers. Investor pressure has become the main catalyst for change. Large institutional investors such as BlackRock and Vanguard have started voting against nominating committees at companies with inadequate diversity, though their standards are inconsistently applied. Some activists have achieved more direct results, such as the New York City pension fund's push for diversity requirements at nearly 20 portfolio companies. But these remain exceptions. The absence of enforceable standards in the U.S. means that diversity efforts depend largely on shareholder advocacy and voluntary action. Arguments against quotas and mandates persist, often framed around concerns about meritocracy. Surveys suggest a significant minority of directors worry that diversity mandates could dilute qualifications. However, available data shows that diverse directors tend to have equal or stronger credentials, with a higher proportion holding industry-specific certifications. The perception of unqualified diversity hires persists, but it is not supported by the evidence. Some companies are experimenting with broader definitions of diversity. Microsoft tracks cognitive diversity, evaluating how directors approach problems differently, while Amazon measures experience diversity to ensure a range of operational backgrounds. These approaches are rare. Only 12% of boards track anything beyond gender and race. But early results show promise, with companies reporting more robust debates and stronger strategy development. The argument that the talent pipeline is lacking no longer holds up. Women now earn more than half of MBA degrees, and minority representation in law and business schools continues to rise. The real bottleneck is the appointment process. Most board seats still go to candidates found through personal networks, not open searches. Even companies that promote diversity externally, like Goldman Sachs, have taken years to achieve balance on their own boards. Compensation disparities remain. Female directors earn about 18% less than male peers, and the gap widens for women of color. These inequities persist even at companies praised for their diversity practices, signaling that symbolic progress can mask deeper issues. Generational change offers some hope. Directors under 50 are more likely to champion intersectional diversity and push for new perspectives, but they remain a minority. Most boards continue to favor seasoned executives, limiting the pace of change. Global comparisons show that U.S. boards lag behind those in countries with stronger accountability measures. France, for example, mandates gender quotas and enforces them, resulting in higher female representation. The U.S. relies on voluntary action and shareholder pressure, which produces slower, uneven progress. Despite political backlash, the trend toward diversity has not reversed. Companies appear to be quietly maintaining or increasing board diversity, even as public rhetoric shifts. The next challenge is to address tenure diversity, as long-serving directors can contribute to groupthink and slow adaptation. Boards that intentionally mix new and experienced members report better decision-making and earlier identification of emerging risks. The way boards approach diversity, whether as a strategic advantage or a compliance requirement, shapes real outcomes. Authentic inclusion leads to better governance, but many companies still treat diversity as a box to check. The persistence of these patterns is closely tied to the networks and the old boys club persistence. Despite the public emphasis on diversity and fresh perspectives, the reality in most corporate boardrooms is that the old boys club still holds firm control. Board appointments continue to favor individuals with established networks and long careers in business, government, or finance. The average S&P 500 director is over 63 years old, and turnover remains low. Many directors hold their seats for a decade or more, reinforcing a culture where relationships and reputation outweigh new ideas. Traditional appointment channels dominate the process. Most new directors are selected through personal referrals or existing board relationships, not open or merit-based searches. For military contractors and defense firms, the pattern is especially pronounced. Companies like Boeing routinely fill board seats with retired generals and former Pentagon officials. Their value lies less in technical expertise and more in their ability to connect the company with government agencies and regulators. Internal communications from Raytheon have even described board members' main responsibilities as opening doors rather than providing oversight. Claims of meritocracy often break down when examining specific appointments. Dana White's election to Meta's board, for example, was driven by his close ties to political figures rather than governance experience. Similar stories play out across industries. Pfizer's board includes a private equity partner whose firm manages the company's legal work, and Apple's recent addition of a young crypto founder was less about domain knowledge than about leveraging Silicon Valley connections. The underlying message is clear. Access and relationships often matter more than relevant qualifications. Educational backgrounds further illustrate the insularity of boardrooms. A large proportion of Fortune 500 directors attended a handful of elite schools, with Harvard alone accounting for more than a fifth of all board seats. Despite women now earning the majority of law and business degrees, the pipeline to board leadership is still dominated by men from these elite institutions. Data from McKinsey shows that graduates from state schools wait years longer for their first directorship compared to their Ivy League counterparts. Geographic concentration adds to the lack of diversity in outlook. Nearly 4 out of 5 directors live in just 5 major metropolitan areas: New York, San Francisco, Chicago, Boston, and Washington. Even regional companies are increasingly led by board members imported from these urban centers, resulting in a homogenized perspective that often overlooks local needs. For example, Walmart's board has shifted away from Arkansas-based directors, now favoring finance and tech executives from the coasts. This concentration can limit awareness of regional trends and customer bases. Younger candidates and those from outside established networks face significant hurdles. Only a small fraction of directors are under 50, and those who do secure appointments frequently encounter barriers to influence. Younger directors are often excluded from key committees or important decision-making, and boardroom dynamics tend to favor those with longer tenures. Analytics from board software firms show that junior directors participate less in discussions and have fewer opportunities to shape outcomes. Defenders of the old boys club argue that these networks provide stability and institutional memory. However, the data suggests otherwise. Companies with entrenched, long-serving boards tend to underperform their peers, both in shareholder returns and risk management. For instance, Boeing's board failed to address safety concerns for years, with directors who had not visited factories or questioned management practices. Long tenure is also linked to higher CEO pay approvals and less willingness to challenge the status quo. Large asset managers like BlackRock and Vanguard have introduced policies to curb excessive board interlocks, voting against directors with more than 4 board seats. Yet, these measures often result in directors simply holding the maximum allowed, rather than reducing the influence of entrenched networks. Despite public statements supporting diversity and governance reform, these firms continue to support the vast majority of incumbent nominees, maintaining the system's stability. Political and military connections remain a significant factor in board composition. Many retired government officials and military leaders transition directly into corporate board seats, particularly in sectors like defense, energy, and transportation. These appointments are often justified by the need for regulatory insight or government relations, but they also raise questions about conflicts of interest and the true independence of oversight. The revolving door between government and corporate boards blurs the line between public service and private gain. Financial entanglements further complicate board independence. Nearly half of S&P 500 directors have outside business relationships with the companies they oversee, including consulting contracts, legal services, or vendor deals. These ties can undermine the board's ability to provide objective oversight, especially when directors' personal income depends on maintaining favorable relationships with management. Generational change has yet to disrupt these patterns. While startups increasingly promote younger leaders and reward merit-based advancement, large public companies still prefer older directors with established reputations. The disconnect is especially pronounced in technology, where board members are often decades older than the founders and executives they oversee. This gap can slow adaptation to new business models and technologies. Some argue that experienced directors are necessary to prevent reckless decisions, but evidence shows that boards dominated by long-serving members are slower to respond to market changes and more likely to miss emerging risks. Companies with more balanced boards, mixing experience with new perspectives, are better positioned to innovate and adapt, but such examples remain the exception. Activist investors have emerged as one of the few forces capable of challenging entrenched boards. While most companies continue to operate with minimal outside scrutiny, activists have begun to push for change, often targeting underperforming or insular boards. Their campaigns signal a growing recognition that the persistence of the old boys club is not inevitable, and that outside pressure can sometimes force meaningful reform.